This episode is intended exclusively to provide information and education to help individuals better understand cycles. However, this information is not be construed as professional advice as to the buying and selling of securities or other investment instruments. In no event does the host express any opinion with respect to or make recommendations regarding the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading securities. Buying and selling decisions are solely within the personal discretion of each individual.
From the mind of Lars von Thienen, the most advanced cycle analysis, hot off the press.
Yeah, welcome. This is the wrong title. Nice to see you. Another episode of Cycles TV. You're watching our weekly Cycles TV. Yeah, today, let's talk about market breadth. So let's talk about market internals and let's talk about different ways to judge the market. And for sure, that's the purpose why we are here. Are there cycles? So that's the topic for today. And I think it could become very interesting. First, why? Normally, you all are aware of, in most cases, we use the price information of an index, a stock, commodity, whatsoever, throw it onto our cycle analyzer and check if we can find cycles in which price series. In the end, price series and the action we will find in price is just the result of something else. So in the end, it would be maybe more interesting if there are underlying data sets which might be dependent or might impact the price at the end, but could give us additional information on dominant cycles, which then might impact the price of something. So, and that's always when you talk about sentiment. Sentiment data sets are this kind of data set, but we also have market internals available at our hand. What are market internals? So, for example, if we talk about market breadth, it is about how many stocks are improving, so advancing, and how many stocks are declining or falling at a given day, a given week, or a month, which gives us an information about the market breadth, either positive if more stocks are advancing than declining, or negative market breadth if more stocks are declining than advancing. And by analyzing that, we are not interested in any price or price swing. We are just interested in the internal market statistics. If we have more stocks which are making higher highs, not high highs, but are advancing their price, are rising, instead of stocks having moving low, so declining stocks. And the delta between advancing and declining then is the kind of market breadth which either is positive or is negative. And then we can monitor how this market breadth evolves over time. I'm sure you know about that topic even better than me. But that's the basic data we are talking today. You will find this kind of data sets at websites like Wall Street Journal. It is reported often in the news. So in most cases, you have the underlying stock or exchange, and then you are counting the issues traded, and then you have the number of advancing and declining issues traded on that index. And with these two kinds of information, you will then create your advanced declining market breadth indicators. You smooth it out, you accumulate it over time, so you can build different kinds of data from advancing and declining information. But now let's think about a moment why this could be important in regards to cycles. Markets will not switch from abrupt up to down, so there will be time involved in when extremes like a lot of advancing issues over more than declining stocks, so we will reach an extreme once we will have the point when maybe, okay, that's advancing either for a long time or the amount of advancing versus declining is too high. So then we will, like an oscillator, this will reverse this kind of sentiment. It will not drop that from a long period you had a lot of advancing issues, and on the other day you have maybe just declining issues. I mean, there could be these days, but this is not the normal condition of advancing and declining. So it will oscillate in normal conditions. You will have always extremes, but the extremes is not the normal condition of that. So under normal condition, you will have an oscillating difference between advancing and declining stocks. Yeah, quite the normal condition you would expect of this data series. So now, if we get away from prices and indices and cycles in a price series, is there a cycle or a dominant cycle underlying these market internals? So maybe there's a cycle defining that, okay, now we have a period where we will have more advancing than declining stocks. And maybe there's another period, which is defined by a cycle, where we have more declining stocks than advancing stocks, because this has nothing to do with an individual commodity, stock, price series or index. This is just a cycle defining the market internals, the market breadth, which could be something completely different and has nothing to do with analyzing the price of an index. So that's what I'm interested in. Maybe there is no cycle. It does not mean there must be a cycle everywhere. But the idea, the hypothesis I want to discuss today is about maybe even the internal conditions of a market are following like this oscillating, vibrating, breathing view of a market, where you have conditions where we will see more advancing that. I mean, this will not give us clue which stock, which issue will maybe advance and which stock or which issue will maybe fall. But it gives us a general idea about what to expect in this period of the market and the other period of the market. So interesting then for indices. But that's the idea. So I don't know if we find a cycle. I mean, for sure, I did this before I put this here on the agenda, but you need to understand what I want to talk about. So now let's get into the data. First, you need to prepare the data now before we can apply cycle analysis. So you need to find a data source where you can find the daily numbers of advancing and declining stock. Often it's published anywhere, so this is public knowledge. It's not so easy to find a reliable data source just to grab or download that data, so I will leave it up to you. I have found a data source. I have created now a daily index, which is just the difference between advancing and declining stocks, and then divided by the total amount of stocks, so to normalize it. And just to show you what I mean by that, so I have created an index, which you will see in a moment, just advancing stock minus declining stock, which is the normal way, and then divided by the total amount of issues. So we want to have this normalized. Maybe the amount of issues could change slightly over time. So this will influence the data. So always divided by the total amount of traded stocks. But that's it. So that way everyone creates the AD, the Advanced Decline Index on a chart. I have then just smoothed it out by a normal standard average of 21 days. Why 21? I don't know, but that's mostly used in smoothing out the AD decline. And now let's get to the cycle scanner to see this in action. So first of all, this is, let me make it better. What you see here in the center is now this calculated AD index divided by the total amount. So if it is above 0, you will see more advancing issues than declining, and the other way around. If it is below 0, you will have more declining stocks than advancing stocks. So by design, this will give us no clue about tops or bottom in the market, but I will come back to that in a moment. So now I have run a full spectrum analysis on the whole data series going back for around 20 years. So this is nothing I would recommend for projection, but this is just to see if there are dominant cycles in this data set which stand out. You see it's over 5,000 bars used for that analysis here, so it's a quite very long analysis. So, and by doing that, there's one cycle really standing out, which, by the way, would anyhow be picked by our algorithm to pick those cycles. And I will come back to that anyhow later again, why that is important. But that's the standard way. Yeah, so no subjective rules. Why picking this or that? That's the standard rule, the most dominant one. It has a very, it's more or less, it's the peakiest one. And my rule is if you try to sit on that peak, it will really hurt. So it is a dominant peak and it's the highest one. So this is the first one, which will hurt you if you try to sit on the spectrum. But that's just a simplistic view. So in the overall data set, there is a dominant cycle. And if we activate this, we can also see, and this is now the period here, 10 years ago. So this is what we're seeing here on the screen, just 2013. So we are now plotting a static cycle. Yeah, so don't get overexcited. We are plotting a static cycle here, but just look 10 years back. I mean, you see the fit of how the timing of that cycle is spot on in regards to the tops and bottoms of the advance and declining index. So yes, there is a rhythm in the market internals. So the overall condition of seeing more stocks which are rising and periods in time when more stocks are falling seems to follow a rhythmic, a cyclic pattern. And not only that, I mean, I think here we can go into 2020, 2023, the same cycle. So, and it's static, yeah? So it's a complete static plot here. I mean, this is a visual alignment. I mean, you would even be able to spot that cycle visually. You don't need a cycle scanner, to be honest, for that. But even it is, I think, clearly to be seen that there is a rhythm in market breadth, in the market internals. You cannot deny that. So, and now jumping into, I mean, we are interested in the more current situation. This is just throwing in all data, just get a general view. Is there a cycle? We just discussed length now. So in forecasting, we also need to have the phase right. And to do that, I always recommend not use the full data set. Use around 1,800, 900 data points. Then you get a better idea about the phase, so the alignment of that cycle. And I mean, have a look at the spectrum. I mean, now it gets even more clear, right? Which cycle would you use? There is just one. There is not a second opinion. There is not a third cycle which would make sense. I mean, this peak in that spectrum here, this is a picture perfect spectrum you could put in a book and explain this is how a dominant cycle peak looks in a spectrum. So sharp, so high statistical significance, high strength score, a green big triangle. The offset to the other cycles is so enormous. So even though look into the past 2 to 3 years, this is the cycle related to market breadth. And I also showed you the past 20 years on that cycle. You see we have now a better or more concrete analysis of the length. It's 54 trading days. It's not calendar days, it's trading days. So it's just a little offset, but you need to be aware of when you overlay this to price data. So 54 trading days, nominal cycle 56 days, is there and has a rhythm of market breadth. So it gives us kind of timing information when we have situations when we could expect to see more advancing than declining stocks, and phases when we could expect more declining than advancing stocks, and windows of time when we could expect a shift in the regime. So when it would change, yeah, you see now it moves up into a point where we reach an extreme. We see, okay, from now we would not expect more advancing than declining. So the rhythm, the sentiment, the market internals slightly will shift to the other side. And that's why I mean it's oscillating. It's not having these abrupt jumps. It's oscillating. And this now defines phases, windows of time, which would be interesting. But for sure, we cannot trade market breadth. We cannot trade the advance and declining index. So what I'm talking about here, sure, let's now put this on a price chart and see if those swings in market breadth can be seen on a price chart. So for sure, that's the expected next steps. I have prepared that here. So I'm using the New York Composite Index just to have, then more or less a broader market view. And what you see now as an zigzag cycle overlay is exactly the cycle which you've seen in our cycle analyzer. It's just rolled over here to that chart. And you see now that's the cycle going back. And if you analyze or zoom in more closely to the situations where we had this cycle bottoming, you see that very often it is matching to market lows or even interim market tops or even interim market bottoms. I mean, it's not working at every cycle moment that you see this reflected in price. But if you have, so the important market tops or market bottoms are always in close alignment with the timing of that cycle when we expect to shift the internal market breadth here. So here, this low, this market low, market top here, and we can even go back in time. This market low, the big low here in October 2022. Yeah, I mean, no discussion. The top here, which came in then early. Here the two tops, which we saw March 2022, and here the big top January 2022. Here that interim bottom. So I mean, there should not be much of question if this rhythm cannot be seen on the price chart. It can. So you can see this rhythm in the price series. So it's and you've seen the peak in the spectrum of market breadth, 55. So that's really no subjective tweaking of something we want to see. This is over 20 years of data, which gives you the 56-day cycle, and analyzing the past 3 years gives you the peak, which I don't want to sit on that spectrum right now. Looking at the price chart, perfect alignment of at least the interim turns we saw on the market. Yeah, and for sure you can now plot this into the future. That's why we are doing all this kind of stuff. But I will come back to the forecast in a minute, because there is there is a second interesting usage of market breadth, which was brought to our attention by a community member out of the foundation. It was about the Fosback absolute breadth indicator. So market breadth has been discussed for over decades in stock markets. So working with this information is something we all just learned from the early analysis and analysts here. And Fosback developed an indicator on that, and I think that's the original publication. Stock Market Logic, a sophisticated approach to profits on Wall Street. Yeah, published 30 years ago. So that's really old stuff, but quite valid. And this was also visited or is used by a friend of the foundation, Tom McClellan, which they publish their own newsletter, and they are also looking in this kind of market breadth information. And the Fosback market breadth indicator is a a little bit different than just the absolute measures which I just showed you. So let's spend a second of understanding the absolute breadth indicator from Fosback, which is using the exact same advancing and declining information, just with the difference that in this case, Fosback was not interested if it is an advancing or declining situation. He was just interested in the absolute change, and regardless if we had more advancing or more declining issues. So just the absolute amount. And in normal conditions, the delta should be quite low, or you should have anyhow more a low reading in that delta. So or the delta in regards of advancing to declining. So the delta is not interesting if they are more declining than advancing, or if they're more advancing than declining. In general, it's just shows you how much extreme the market condition is in the one or the other direction. So that's why he was just using the absolute information, not if it is a positive delta or a negative delta. And by doing that, it's also a kind of market activity, which he was measuring using market breadth. So instead of using if it's going up or going down, and what we did then applying cycle analysis, he was just interested in the absolute reading kind of market activity index, but it's an absolute breadth indicator. And he was also normalizing that, so dividing that by the total amount of traded issues so that you have normalized that value, smoothing out using a standard average of 21. So very simple usage, and then calculated this absolute breadth indicator in terms of. And high readings just indicate that there's an extreme situation, either advancing or declining overall in the market, which is a kind of extreme or chaotic situations. So high readings of the Fosback market breadth show you that there's a chaotic situations because you have large upswings and downswings and maybe even following in short amounts of time. And if you average that out, you will then see that you have an average high reading of that absolute breadth, regardless of the direction. And you will find low readings when there is no high activity in the one or the other round. So it's also kind of volatility measure. And what Fosback then found out and published was that these chaotic readings of this indicator occur at market bottoms. Occurs at market bottoms or at crashes, or when we go down extreme, you have this high volatility with short-term upswings and downswings, which would give you a high reading also in the overall market breadth Fosback indicator. So the market internals would show that chaotic situation, which is in most cases related to market bottoms, or the other way, you could expect even the market to rise out of that situation. So high readings would imply market bottom. It's important to understand because the interpretation is exactly the opposite of the reading of that indicator. While if you see low scores of the absolute breadth indicator from Fosback, it means this is kind of normal condition which you see at market tops. Market tops are not so fearful and chaotic, so they are more quiet. You will see low readings of the absolute breadth. There's not a lot of high volatility, so low readings of the Fosback market breadth could be observed at topping markets. So that's the general explanation. And then you can calculate that indicator similar to the normal advanced decline indication, just using the absolute measures. And for sure, I have calculated that indicator for you. And now we will put the cycle scanner on that data set also. So here we have now this is the calculation I tried to explain, but as said, it's public knowledge how to calculate the Fosback market breadth indicator. It's also oscillating around not zero, but it's oscillating. So you will find high readings As said, this is not meaning that we have more advancing issues. That is just that the delta is very high. So either more declining or more advancing. This will cause a high reading. Low readings means we have a very low activity. So the smoothed average is very low. So now the idea which he published was, okay, these high readings should be more seen at market bottoms and low readings should be more seen at market tops. So that's the reading. But we are now interested in, is there also a cyclic behavior which can be seen in this kind of using the data, the market internals? Yeah, and again, I think you can spot this on your own. I mean, if these are not clear peaks in the spectrum, what else are we looking for? Yeah, if not these two. So again, similar to the standard market breadth cycle, we also have here two clear cycles. So there is no discussion if there is a cyclic behavior. There is. That's what digital signal processing shows us with high statistical significance. And we can now use one, or we can build the composite out of these cycles. I will just show you the first cycle here. And again, we see a very, very nice correlation when we see the extreme readings here. And as said, it's different to what I've shown you before. So when we have extreme chaotic market conditions and when we have extreme quiet, silent market conditions, it's also a rhythm in these market conditions. So we have a measurement and we have now a time measurement and when to expect chaotic, wild markets, high volatility, and when we could expect market times with low absolute readings, quiet period, low volatility. So there is, and this is not a cycle derived from price. This has nothing to do with the price of stocks or indices. This is just analyzing market breadth. So again, we have cycles. We can visually confirm those cycles, what digital signal processing anyhow told us already. It's not the same cycle, so that's interesting here. And we need to read the cycle now. If we switch to the price chart again, we just need to remind ourselves this cycle needs to be inverted on the price series. So these extremes here would correlate to market bottoms and the other way around. But to make it complete and to make it more useful, let's activate here both cycles. So a composite of these two cycles, which is a little bit altering. I mean, the general turns here are not really changed, but the composite gives it a more interesting view. And I mean, let's talk about cycles here. So let's bring more cycles into the mix here. So now we're doing the same. We are rolling over exactly this cycles here to the price series now. And let's see if we also find a clue from these cycles here. So I have prepared that for you already. Let's get back to this chart. Let me remove the first cycle and let's now have a composite view at this cycle. That's exactly the same cycle you've seen from the scanner. It's just inverted, right? You might remember here the low is here, I think end of this week, 18th of August. And if we switch back to the cycle here, it's exactly the top of the composite here, 18th of August, right? So just that you can trust me here on what I'm doing. So this top is this low here, okay? So now let's first zoom into the past and see if we can also see an alignment with this inverted cycles in the absolute breadth indicator from Fosback. And I mean, that's also quite interesting. You could assume here this is a zigzag derived from the price series, but it is not. Yeah, it is the pure Fosback indicator, which seems to be true, having an alignment that the extreme readings, which are shown here as bottom, more indicate market bottoms, And the high readings, so these are the quiet periods, so high reading on the inverse visualizations here, these are quiet periods, more are in alignment with market tops. Yeah, so, and we can now move forward here. So very high reading on the indicator, which is a cyclic low, cyclic top, cyclic low. So, I mean, it's quite perfect alignment of this interim top here with this cyclic situation. Yeah, and then moving forward for sure. You know that we are not looking for the price alignments. We are just looking for alignments in time. I mean, you cannot time on the day, but you see the regime shift in the underlying market internals is then also to be seen in price. Yeah, now we can also forecast this into the future. And now let's put both cycles on the chart, because the most important points in time, and that's what we always look for from a cycle analysis point of view, we want to have a confluence, a multitude of cycles which come into alignment. And when a multitude of cycles comes into the same alignment, which means they align at the same time for bottoming or topping, then we have a high confirmation. That's not always the case. Often you have overlapping cycles with different phases. But when these cycles align, then you have even more confidence about the cycles. And this is now moving back a little bit in time to see an alignment when these cycles align. So here the bottom in October last year, where this low point was happening, is exactly at that point. Here, close alignment with the top. Then you have overlapping cycles, which might not give you a real clue on the price. But if you then look back here, here we have a top alignment at that point. Here a perfect alignment again in the low point, so the October 2022. Then the major top here late. Oh no, that's an interim top, but this top here in late 2021. Let me zoom in here. So this was the major top, which was in alignment by these two cycle tops here in alignment. Then we had a little bit out of phase for both cycles, but then you look, the major bottom occurred. So just looking up for these major cycles. So the key alignment of the top was here seen October 2021. Yeah, so and it was the major market top we have seen here. And then you need to move into this point in time here, October 2021, when we have the next core alignment when both bottom out. And this have been the major key reversals of the markets. And then in between, you will find different situations when those cycles align. But you know, this is cycle confluence. This is cycles within cycles. This is what we're looking for. And yeah, for sure. I mean, what's now the reading looking forward? We are not just interested from the scientific point of view. I hope now you understand why I took the time to explain all of this. Right now, let's start with today. Today is a little bit cluttered here and overlaid between these two market breadth cycles, which don't speak clear message. Yeah, you see the phase is shifted a little bit. We could maybe expect an interim low here late August, early September. But this top here, end of September, looks like a quite big alignment of the topping cycles, or the next one here even also, which is then November, December. And that's my key message. If you have watched the episode on major dominant cycles, so the 40-month cycle, which is in place, which is topping out November this year, we have a lot of other time cycles, which I always pointed out, September, November is a key period when a lot of time price-based cycles are topping. And I was just fascinated that market internal cycles point to a similar alignment, latest by end of September, into the period of November. So the core election window for the US is not really looking good in regards to time cycles on market internals. So here you have it. So I think key takeaway is, and I've never looked on market cycles for market breadth. So that's quite a new area to go more deeper. Second, what's quite fascinating, there are without doubt key cycles which you will find in a spectrum analysis. You've seen the 54 trading day cycle in the normal advanced deadline, and you've seen the other two peaks in the spectrum of the Fosback RD reading of the absolute breadth. This is quite special. You won't have often these situations when you have such peaks in a spectrum. Picture perfect. So we have those cycles. You've visually confirmed that, and now overlaying the market internal cycles to market price action, when both market breadth cycle concepts align, cycles within cycles alignment, these two frameworks on market breadth, then in the past we have seen major key reversals in the market. So this might help us looking into the future to get a clue on when to expect the next major point in time when the regime, the market internal, will change its breathing. Yeah? And then you could expect price series, which is just a consequence out of the market internal cycle. Okay. Lot of potential area to follow up. And I hope maybe you are inspired now to do your own research on these kind of cycles. Market cycles are there for different stocks and not stocks, stock exchanges. So you could see it just for technology on the Nasdaq. You could see it for the Dow Jones. So advancing and declining stocks on different exchanges is there as a data series, maybe also intraday. So why not? So quite big area. And I like that area because it's not directly related to price. We are really analyzing something which might be more important than price on its own. Okay, as always, let me take some time for your questions. So if you want and if you have not already put in your questions, I will now spend some time to go over the chat section. I think smiles are good. I think I did that right. So I think your question was coming early when I explained all the data. So what do you think of overlay the market breadth and the S&P 500? Exactly. That's at the end what I did. And this, there is a correlation. I hope you've seen that. Are you still there? So not more questions. So just feel free to drop in. Smiles are good. So okay, fine. I think we touched on that. So that's the main purpose. Yeah, maybe I just touched a new topic. So maybe we don't have so specific questions. But in the end, I would promote and encourage you, try to find your data sets, invest a little bit in upfront thinking about how could I prepare my data before jumping to the cycle scanner. I think that could maybe even more valuable than jumping to a stock or index and clicking buttons on cycle analysis. If you do the right thinking about what data do I want to research and analyze on cycles, that could really be rewarding. And we offer the possibility to upload any individual data series you can think about. So there are no limits. And this is one example just highlighted today. So then let's call it a day. Let's get back to work or wherever you are. Have a nice week out there. And let's follow up. End of the year. We need to wait a little bit to see if this works out. But See you soon. Have a nice time. Leave me your comments down below. Like, subscribe, tell your friend, and we will see each other